Year one of self-employment has one financial surprise that lands harder than any other, and it's almost always self-employment tax. Coaches who built a tax reserve on a generic 30% rule walk into April and find the federal bill is bigger than they planned for. The cause is structural. This unit walks the calculation, names the rate, surfaces the half SE tax deduction that softens it, and points at the S-Corp lever that changes the exposure entirely. Most coaches first meet self-employment tax in April of their first founding year. When you held a W-2 job, your employer paid half of Social Security and Medicare for you, and you never saw the line on your pay stub. Now you are the employer and the employee. Both halves are yours. 15.3% of net self-employment income, on top of regular federal income tax, on top of state tax, on top of any local obligation. The amount is large, and it does not show up anywhere in your monthly bookkeeping unless you put it there. The rate decomposes into two pieces with different rules. 12.4% is the Social Security portion, and it stops at an annual wage base that the IRS resets for inflation every year. Verify the current year cap before filing because the number moves. 2.9% is the Medicare portion, and it has no income cap. It applies to every dollar of net self-employment income at every income level. And one more wrinkle that catches people. The rate runs on 92.35% of net Schedule C income, not the full gross profit. The 92.35% adjustment looks like a quirk and isn't. It mirrors a piece of the employer-side payroll math that W-2 employees never see. The employer half of FICA is itself an expense, and the adjustment lets the self-employed equivalent work the same way. The form walks the arithmetic line by line. The concept to hold is simpler. You're paying both halves of the payroll tax, scaled by a small adjustment that approximates how it would have looked if your business were a separate employer paying you a salary. The Social Security wage base cap matters mostly as context for the years ahead. Below it, the full 12.4% Social Security portion applies. Above it, only the 2.9% Medicare portion continues uncapped. Very few coaches hit the wage base in their founding year. It starts becoming a real factor at mid to high six-figure net income. Verify the current year number before filing because it inflation adjusts annually, and the figure you remember from a friend's situation last year is already stale. Above 200,000 single or 250,000 MFJ, an additional 0.9% Medicare Surtax kicks in. It applies to net SE income or W-2 wages above the threshold. For most coaches in the founding years, this is reference rather than focus. Useful to know it exists, because the moment income clears the threshold, the rate quietly bumps. The number isn't huge per dollar, but it stacks on top of everything else, and missing it in a projection means the tax reserve runs short at exactly the income level where the dollar amount of the shortfall hurts most. Half of the SE tax you just computed comes back as an above-the-line deduction on Schedule 1, line 15. Automatic on Form 1040 if you're filing the return correctly. It reduces AGI, which means it reduces income tax, but it does not reduce the SE tax itself. The deduction is doing two things at once: lowering the income tax base and partially offsetting the felt sting of paying both halves of payroll tax. If the deduction isn't showing up on your prior year return, something is wrong with how it was filed. The S-Corp election is the structural lever that changes the SE tax base entirely. Inside an S-Corp, you take a reasonable salary through payroll. That piece is subject to payroll taxes at the same combined rate as SE tax. The remaining profit comes out as a distribution and is not subject to SE tax at all. The savings come from splitting the income between the two buckets. The lever is real and the math is meaningful, but the salary has to be reasonable for the work. The IRS pushes back hard on token salaries. Module 11 walks the full mechanics and the reasonable salary methodology. Run the math on a $60,000 net Schedule C year. 60,000 times 92.35% equals 55,410. That number times 15.3% equals roughly $84.78 in self-employment tax. Federal income tax then runs on top of that same profit, computed on the income reduced by the half SE deduction of about $42.39. Two stacked taxes computed on overlapping but not identical bases, and both due in the same April. This is the exact shape that empties a 30% tax reserve in year one. Project your number before you need it. Pull your year-to-date net Schedule C income, or your projected number if you're building the reserve forward. Multiply by 92.35%, then by 15.3%. That's your SE tax projection. Have it. That's the deduction that will reduce your AGI when the return is filed. Move the projected SE amount to the tax reserve account from Module 6.4 on top of the income tax reserve. The reserve covers both. Underestimating SE tax is the most common reason the reserve runs dry in April.